Welcome to the very first episode of Nova Bourse US. Today, we are beginning our journey into the foundations of personal investing. We are going to demystify the ownership slice that powers American capitalism. This is Season 1, Episode 1, What is a Stock? To understand the power of the stock market, you have to appreciate its sheer scale. As of mid-2026, the total market capitalization of all publicly traded companies in the United States reached $75.3 trillion. This massive figure accounts for every company listed on the New York Stock Exchange, the NASDAQ, and the over-the-counter markets. A stock is the specific instrument that allows you, an ordinary individual, to own a piece of this vast machine. With roughly 3,700 domestic companies trading on the two major U.S. exchanges alone, the opportunities are vast. But before we talk about picking winners, we must first master the fundamentals of what a stock actually is. The growth of this ecosystem has been staggering. At the end of 2009, the U.S. stock market was valued at roughly $15 trillion. By mid-2026, that figure ballooned to $75 trillion. That is a roughly 400% expansion in just 17 years. This isn't just an abstract number on a screen. Every dollar of that growth represents real value created and then distributed to shareholders through a combination of price appreciation and dividends. If you compare this trajectory to the typical interest rates found in basic savings accounts, you can quickly see why understanding stocks is the essential starting point for any serious long-term wealth-building strategy. This is not investment advice, but rather the necessary context for your financial future. At its core, a share of common stock is a legal claim on a fraction of a corporation's assets and earnings. If a company has 1 billion shares outstanding, and you purchase 100 of them, you own 0.00001% of that entity. Crucially, this is not a loan. You are not a creditor. You are a partial owner. This distinction grants you rights that lenders simply do not have. There are 4 pillars that define what this ownership means in practice: your capital contribution, your rights to dividends, your voting rights, and the protection of limited liability. These pillars are what transform you from a spectator into a participant in the economy. To understand your ownership, we have to look at the hierarchy of share counts. First, there are authorized shares, which is the maximum amount a company's charter permits it to issue. For example, Apple once had 50.4 million shares authorized, though that number was increased later. Next, we have issued shares, which are the ones the company has actually released. Finally, we have outstanding shares, which are those issued shares minus any treasury stock the company has bought back. As of early 2026, Apple has approximately 14.69 billion shares outstanding. This distinction is vital because your personal ownership percentage is always calculated against these outstanding shares, not the authorized total. Now, let's address a legal relic known as par value. This is the nominal dollar amount assigned to each share in a company's charter. Apple's common stock carries a par value of $0.00001, which is 1/100,000th of a cent. In 2012, Apple explicitly switched to this microscopic value to reduce corporate expenses. While par value has almost no economic meaning in today's market, it remains legally significant. It determines the minimum price at which shares can be issued and appears on financial statements under the shareholders' equity section as common stock at par. It is a reminder that even modern tech giants are bound by traditional corporate law. So, how do we value a company? We use market capitalization, which is simply the current share price multiplied by the number of shares outstanding. If Apple trades at $315 per share with 14.69 billion shares outstanding, its market capitalization sits at approximately $4.63 trillion, making it the largest company in the United States. It is important to remember that market cap fluctuates constantly as the stock price moves throughout the day. However, the number of outstanding shares only changes when a company decides to issue new equity or execute a buyback program. One of the most attractive features of ownership is the dividend. This is a distribution of a portion of a company's earnings to its shareholders, usually paid out in cash on a quarterly basis. Not every company pays them, as many growth-oriented firms choose to reinvest all their earnings. Apple is a fascinating case study here. They paid quarterly dividends from November 1988 until November 1995, but then suspended them for 17 years to focus on aggressive reinvestment. In March of 2012, under CEO Tim Cook, Apple resumed their payments. That was a pivotal moment, signaling the company's transition from a pure growth play into a mature, massive cash generator. Let's look at the actual numbers behind Apple's dividend growth. When they resumed payments in 2012, the initial quarterly dividend was roughly 18 cents per share on a split-adjusted basis. By 2024, that payment had risen to 25 cents. Following subsequent increases in 2025 and 2026, the dividend reached 27 cents per share. With 4 payments a year, the annual dividend per share now totals approximately $1.04. This 12-year track record of consistent increases is a perfect illustration of the concept of dividend growth, showing how a mature company rewards its long-term shareholders. To compare these payments across different stocks, we use the dividend yield. This is the annual dividend divided by the current stock price, expressed as a percentage. In recent years, Apple's yield has fluctuated between 0.33% and 0.7%, landing at 0.4% in 2024. While this might seem low, context is everything. Apple's stock price has risen much faster than its dividend, which compresses the percentage yield. Many tech companies pay no dividend at all, so a low yield isn't necessarily a bad sign. It often indicates that investors expect significant price appreciation rather than immediate cash income. Another metric to watch is the payout ratio, which is the total dividends paid divided by the company's net income. This shows how much of the profit is returned to shareholders versus how much is kept for reinvestment. Apple's payout ratio has hovered around 15% lately, meaning they retain 85 cents of every dollar earned to fund acquisitions and buybacks. Even during the pandemic uncertainty of 2020, when earnings dipped, the payout ratio only rose to 24%, while the dividend remained steady. This conservative approach is intentional. It signals to the market that the dividend is safe and can continue to grow, even if the economy hits a rough patch. Beyond the money, ownership grants you a voice. Under U.S. corporate law, each share of common stock typically carries one vote. You exercise this right at the annual meeting to elect the board of directors or vote on major actions like mergers. In practice, you won't be flying to headquarters for these meetings. Instead, you will receive a proxy statement electronically. You cast your vote remotely, which is known as proxy voting. The board is legally required to solicit your vote and fully disclose all material matters and filings with the Securities and Exchange Commission, ensuring that even the smallest shareholder has a seat at the table. One of the most tangible ways you exercise this power is through say-on-pay votes. Under the Dodd-Frank Act of 2010, public companies must hold these advisory votes on executive compensation at least once every 3 years. Shareholders get to vote to approve or disapprove the pay packages of the CEO, the CFO, and the 3 next highest-paid executives. While these votes are technically non-binding, they are incredibly influential. Companies that receive low approval ratings often engage directly with shareholders to revise their compensation structures. This is a real, functional mechanism of corporate accountability that comes standard with your stock ownership. However, there are exceptions to the one-share, one-vote rule called dual-class share structures. Some companies issue different classes of stock with varying voting rights. This is perfectly legal and must be disclosed at the time of an initial public offering. But it means that outside shareholders have less influence than their economic stake might suggest. The Ford Motor Company is the classic example here. The Ford family holds Class B shares that carry significantly more voting power than the regular common stock held by the public. This dual-class structure has been a fixture at Ford since the company went public way back in 1956. To see how powerful this is, look at the data from 2010. The Ford family owned less than 2% of the total equity in the company, yet they controlled 40% of the voting power. This structure was originally set up in the 1930s by Henry Ford and his son Edsel for estate planning purposes. Interestingly, shareholder proposals to move to a one-share, one-vote system have received majority support from independent shareholders every year since 2011. Yet, the dual-class structure persists because the family holds enough voting power to block any changes. It is a stark reminder of how voting rights and economic ownership can diverge. Berkshire Hathaway offers a different but equally interesting dual-class model. Their Class A shares trade at over $600,000 each and carry full voting rights. In 1996, Warren Buffett created Class B shares to stop investment trusts from creating look-alike products. After a 50-for-1 split in 2010, each Class B share carries 1/10,000th of the voting rights of a Class A share and trades at roughly 1/1500th of the price. While Class A shareholders can convert to Class B, the reverse is not true. This structure preserves voting control for long-term owners while making the stock accessible to smaller, individual investors. Perhaps the most important protection you have as a shareholder is limited liability. This is the legal principle that caps your potential losses at the amount you actually invested. If you buy $1,000 worth of stock and the company goes bankrupt, you lose that $1,000, but creditors cannot come after your house, your car, or your personal savings. This separation between corporate debt and personal assets is the bedrock of modern capitalism. Without this protection, very few people would be willing to risk their capital in the public markets. As a shareholder, you are an owner, not a guarantor of the company's debts. The collapse of Lehman Brothers in September of 2008 provides a dramatic example of this. When the firm filed for Chapter 11 bankruptcy, the largest in U.S. history at the time, shareholders saw their investment drop to zero. Every dollar they had in the stock was lost. Yet, that was the end of the story for those investors. No creditors came for their personal assets, and no courts pierced the corporate veil to seize their homes. The loss was total within the investment, but it was strictly contained. That is the power of limited liability, and it is the same protection afforded to every stockholder, regardless of the size of their position. Before we conclude, let's distinguish common stock from preferred stock. Preferred stock is a hybrid between common stock and a bond. Preferred shareholders receive fixed dividend payments before any money is paid to common shareholders, and in the event of a liquidation, they stand ahead in line for assets. However, preferred stock usually carries no voting rights or only limited rights if the company misses dividend payments. It appeals to income-focused investors who prioritize stability over the growth potential of common equity. It is a distinct asset class, but both forms represent a piece of the company's equity structure. Finally, let's talk about share buybacks, which is when a company uses its own cash to purchase its shares from the open market and retires them. This reduces the total number of outstanding shares, which directly increases the ownership percentage of every remaining shareholder. Apple is the poster child for this strategy. Its shares outstanding peaked at roughly 26 billion in 2012 and have steadily declined to 14.67 billion through the repurchase of over $600 billion in stock. This means your ownership stake in the company grows automatically, even if you never buy another single share. To synthesize everything we have covered today, remember that a stock is not a lottery ticket. It is a legal instrument defined by 4 specific pillars. First, your capital funds the business. Second, you are entitled to a share of distributed profits through dividends. Third, you generally have a vote in corporate governance. And fourth, your risk is bounded by your investment through limited liability. These 4 attributes are what separate stocks from bonds, options, or commodities. Understanding these pillars is the absolute prerequisite for everything else we will cover in this series. And it is the foundation of your journey as an investor. You now understand what a stock is, but how does your buy order actually become a share in your account? In Episode 2, we are going to follow the journey of a single order from the moment you click buy on your brokerage app to the exact instant it matches on the exchange floor. We will meet the market makers, decode the order book, and explain why the New York Stock Exchange and the Nasdaq operate on Eastern Time. We will also look at what happens during those critical first and last 30 minutes of the trading day. I look forward to seeing you there.